The single greatest threat to your financial future isn't a market crash, a recession, or a bad tip from your brother-in-law. The most dangerous and relentless enemy you will ever face in the quest for wealth building is staring back at you in the mirror every single morning. It's the 3 pounds of electrified meat between your ears, an evolutionary marvel that is, unfortunately, catastrophically hardwired to make you lose money. Your brain is lying to you. It whispers temptations of quick riches and screams warnings of phantom risks. It pushes you to buy when prices are highest and panic sell when they are lowest. This isn't a personal failing, it is a human failing. The greatest investors in history are not necessarily the ones with the highest IQs or the most complex algorithms. They are the ones who have waged and won the internal war against their own psychology. And no one has waged this war more successfully, for a longer period of time, and with more spectacular results than Warren Buffett. His entire career is a monument to a single profound truth. Mastering the market begins with mastering your mind. What we are about to embark on is not just a lesson in finance. It is a deep dive into behavioral finance, a journey into the dark corners of your own investor psychology to expose the cognitive traps that have been sabotaging your portfolio management for years. This is the financial education they never taught you in school. We will deconstruct the mental architecture of the world's greatest capital allocator, not to mimic his stock picks, but to clone his investment mindset. By the end of this, you will possess a framework to override your worst instincts, turning your brain from your biggest liability into a disciplined, rational, and ruthlessly effective investing machine. This is the path to true capital preservation and generational wealth building. The journey begins with confronting the most seductive and destructive force in all of finance, the deafening roar of the crowd. The first and most powerful psychological demon that an investor must conquer is the urge to run with the herd. This is the siren song of social proof, the deeply ingrained instinct that tells us if everyone is doing something, it must be the right thing to do. In the ancestral savanna, this bias was a survival mechanism. If everyone suddenly started running, you didn't stop to analyze the fundamentals of the lion's teeth-to-claw ratio, you ran. To be left behind was to be eaten. But in the modern savanna of the stock market, this same instinct is a recipe for financial slaughter. It compels you to buy assets not when they are cheap and unloved, but when they are expensive, popular, and plastered across every news channel, precisely at the moment of maximum risk. It creates a terrifying feedback loop of emotional investing, where rising prices create euphoria, which attracts more buyers, which pushes prices even higher, until the entire edifice collapses under its own weight. Warren Buffett's entire philosophy is built on the violent rejection of this instinct. His most famous aphorism, "Be fearful when others are greedy, and greedy only when others are fearful," is not just a clever quip, it is the foundational pillar of his 9-figure fortune. It is a command to wage war on your own hardwiring. To understand the sheer power of this principle, we must travel back in time, to an era that has become a legend, a cautionary tale of mass delusion that perfectly illustrates the madness of crowds, the dot-com bubble. The late 1990s were not just a time of economic prosperity, it was a time of cultural hysteria. The internet, a technology that had been bubbling in academic and military circles for decades, had finally burst into the public consciousness. It promised to change everything: how we shop, how we communicate, how we work, how we live. And with that promise came a stock market mania, unlike anything seen since the Roaring '20s. Companies with no profits, no revenues, and sometimes no viable product at all were adding .com to their names and watching their stock prices multiply by 10, 20, or even 100 times. A 25-year-old analyst on CNBC was given more credibility than a seasoned business owner. The old rules of valuation, things like earnings, cash flow, and book value, were declared obsolete relics of a bygone industrial era. This was a new paradigm, they shouted, where eyeballs and clicks were the only metrics that mattered. The retail investor, armed with new online brokerage accounts from E-Trade and Ameritrade, piled in, convinced that this was a can't-miss, once-in-a-lifetime opportunity for financial freedom. Everyone they knew was getting rich. Their neighbor, their dentist, the guy who bagged their groceries, all had a hot stock tip, a story of a small investment that had exploded in value. The pressure to join the party was immense, almost physical. To sit on the sidelines was to feel like a fool, a dinosaur, willfully ignoring the future. And where was Warren Buffett in all of this? He was in Omaha, Nebraska, being openly mocked. In July of 1999, at the height of the frenzy, Buffett attended the annual Sun Valley Conference, a lavish gathering of the biggest names in media and technology. He was surrounded by the high priests of the new economy, people like Jeff Bezos of Amazon and Steve Case of AOL. He was the old man, the relic. In a now-famous article, Barron's magazine published a cover story titled, "What's Wrong, Warren?" The piece questioned whether the Oracle of Omaha had lost his touch. His company, Berkshire Hathaway, was dramatically underperforming the market. Its portfolio was filled with boring, old-economy businesses like insurance, furniture, and candy. He refused to buy the hot tech stocks. He admitted he didn't understand their business models and couldn't confidently project their earnings a decade into the future. The article, and the broader market sentiment it represented, portrayed him as a man out of time, whose simple principles of value investing were no longer relevant. Imagine the psychological pressure. He was being called a has-been by the most respected financial publications. His shareholders were watching the NASDAQ Composite Index soar over 85% in a single year, while Berkshire's stock stagnated. His peers, the titans of industry, were all believers in the new paradigm. Every signal from the outside world, every piece of social proof, was screaming at him that he was wrong. The herd was stampeding toward a glorious future, and he was standing perfectly still. This is where the story pivots from a simple business decision to a masterclass in investor psychology. Buffett did not panic. He did not change his stripes. He did not capitulate to the overwhelming social pressure. He simply stuck to his lifelong discipline. He read his annual reports. He analyzed balance sheets. And he waited. He was practicing the highest form of contrarian investing, not for the sake of being different, but for the sake of being rational in an ocean of irrationality. He knew the difference between the price of a stock and the value of the underlying business. The prices of these dot-com companies were detached from reality, floating on nothing more than hope and hype. The businesses themselves were often burning through cash with no prospect of ever turning a profit. When asked why he wouldn't invest in these high-flying tech stocks, his answer was devastatingly simple. You have to be able to look at the company and say, what is this business going to be worth in 5 or 10 years? If you can't answer that, you can't buy it. The dot-com CEOs couldn't answer that question. The Wall Street analysts couldn't. The retail investor certainly couldn't. They were all just gambling on market sentiment, betting that the price would go up tomorrow because it went up yesterday. They were caught in the herd. Then, in March of 2000, the music stopped. The bubble burst. The NASDAQ, which had peaked above 5,000, began a brutal, gut-wrenching collapse. Over the next 2 years, it would fall nearly 80%. Companies that had been worth billions of dollars one day were bankrupt the next. Pets.com, Webvan, eToys, names that were once symbols of the new economy became punchlines. Trillions of dollars in paper wealth vanished. The dreams of financial freedom for millions of retail investors turned into a nightmare of margin calls and catastrophic losses. And Warren Buffett? He didn't just survive. He thrived. As the tech darlings imploded, investors fled back to the safety of real businesses with real earnings, businesses like the ones Berkshire Hathaway owned. His discipline wasn't just vindicated. It was rewarded on a colossal scale. While the herd was being slaughtered, his capital preservation strategy had worked perfectly, and he now had a mountain of cash ready to deploy into a market filled with fear and bargains. This story is not just about avoiding a bubble. It is the ultimate demonstration of fighting the herd mentality. It took unimaginable psychological fortitude to withstand the ridicule and the apparent opportunity cost of 1999. It required a deep, unshakable conviction in his own independent analysis, a conviction strong enough to drown out the roar of an entire world telling him he was an idiot. This is the first and perhaps most crucial pillar of the Buffett mindset. True investment intelligence is not about agreeing with the crowd, but about having the discipline to disagree when the crowd is insane. The psychological principle that drives the dot-com bubble and every speculative mania in history is known as social proof, or more commonly, herd mentality. This isn't a sign of low intelligence, it's a fundamental feature of human cognition. Our brains are wired to use the actions of others as a shortcut for decision-making. When we are uncertain, we look to the group for cues on how to behave. This is an efficient heuristic for most of life. If you walk into a new office and everyone is quiet and typing, you intuitively lower your voice. If a fire alarm goes off and everyone runs for a specific exit, you follow them. In these situations, trusting the herd is logical and saves cognitive energy. The problem is that the stock market is one of the few domains in modern life where this instinct is not just wrong, it's actively toxic to your success. In the market, the crowd is often most confident at the exact moment it is most wrong. The very nature of market peaks is that they are formed when the maximum number of people have finally bought in, driven by euphoria and the fear of missing out. At that point, there are very few new buyers left to push prices higher. The crowd provides comfort, but in investing, comfort is inversely correlated with returns. When an investment feels safe, easy, and obvious because everyone you know is doing it, it is almost certainly overpriced and dangerous. This bias is amplified by two other powerful psychological forces: the narrative fallacy and the fear of missing out, or FOMO. The narrative fallacy, a term coined by Nassim Nicholas Taleb, describes our tendency to create simple, coherent stories to explain complex, random events. During the dot-com boom, the story was irresistible. The internet is changing the world, and these companies are the future. The old rules don't apply. This story was simple, compelling, and emotionally satisfying. It allowed people to ignore the messy reality of non-existent profits and insane valuations. It was easier to believe the story than to do the hard work of financial analysis. FOMO is the emotional engine that powers the herd. It's a primal anxiety that others are experiencing rewarding opportunities from which we are absent. Watching your friends and neighbors seemingly get rich overnight on dot-com stocks created an intense, visceral pressure. It wasn't just about greed, it was about the fear of being left behind, of looking foolish for your prudence. This combination, the shortcut of social proof, the seduction of a simple narrative, and the intense emotional pressure of FOMO, creates a perfect storm of irrationality. It short-circuits the rational, analytical parts of our brain, the prefrontal cortex, and hands control over to the ancient, emotional, and impulsive parts, the limbic system. When you are in the grip of the herd, you are not really thinking, you are reacting. You are not making an investment, you are seeking social validation. Buffett's genius is his systematic override of this entire process. He has structured his life and his decision-making process to insulate himself from the madness of the crowd. He lives in Omaha, Nebraska, far from the frenetic, rumor-driven echo chamber of Wall Street. This physical distance creates psychological distance. He famously says he doesn't have a stock ticker in his office. He doesn't watch financial news channels that thrive on minute-to-minute market sentiment. He focuses on reading annual reports, industry journals, and books, sources of deep, factual information, not fleeting opinions. He is intentionally starving his brain of the very inputs that trigger the herd mentality. He forces himself to rely on his own analysis, creating an intellectual moat around his decision-making process. This is the essence of behavioral finance in practice. It's the recognition that your default mental state is your enemy, and you must proactively build systems and habits to counteract it. So how can a regular retail investor who doesn't have the luxury of living in Omaha and managing billions of dollars apply this principle? How do you build a mental model to systematically dismantle the herd mentality in your own portfolio management? The blueprint is a contrarian's checklist, a step-by-step process to force rational, independent thought when your emotions are screaming at you to follow the crowd. Step 1. Identify the dominant narrative. The first thing you must do when you feel the pull of a popular investment is to stop and articulate the story everyone is telling. Write it down. Is it AI is the future and this chipmaker is the only game in town? Is it electric vehicles are taking over and this stock is the next Tesla? Is it this cryptocurrency is going to replace the dollar? Be specific. By defining the narrative, you transform it from an ambient, emotional feeling into a concrete hypothesis that can be tested. A popular narrative is not automatically wrong, but it is automatically suspect, because its popularity means much of its potential is likely already reflected in the price. Step 2. Measure the sentiment. You need to quantify the greed or fear. Look at objective indicators. One of the most famous is the VIX, often called the fear index. When the VIX is very low, it indicates complacency and a lack of fear in the market, often a warning sign of a top. When the VIX is extremely high, it signals widespread panic, often presenting a buying opportunity. Another great tool is the CNN Fear and Greed Index, which synthesizes 7 different indicators, like market momentum, junk bond demand, and put/call options, into a single number from 0 to 100. When this index is pegged at extreme greed, the herd is euphoric. When it's at extreme fear, the herd is terrified. Your job is to use these tools as a thermometer for market sentiment, not as a timing tool, but as a crucial piece of context for your own decision-making. Step 3. Invert the problem. This is a mental model championed by Buffett's partner, Charlie Munger. Instead of asking, "Is this popular narrative true?" ask, "What would have to be true for this narrative to be catastrophically wrong?" For a hot tech stock, you might ask, "What if a competitor develops better technology? What if regulators step in? What if their profit margins are competed away? What if the market has overestimated the size of their addressable market by a factor of 10? This inversion forces you to actively search for disconfirming evidence, which is a direct antidote to the confirmation bias that fuels herd behavior. You are deliberately putting on the black hat and playing the role of the ultimate skeptic. Step 4. Anchor to business fundamentals, not price action. The herd is obsessed with price. It's going up is their entire thesis. You must ignore the price and focus exclusively on the value of the underlying business. This requires work. It means opening the company's 10K report. It means calculating its price-to-earnings ratio, its price-to-sales ratio, and its debt-to-equity ratio. How do these numbers compare to the company's own history and to its competitors? Are its revenues growing? More importantly, are its profits and free cash flow growing? You are acting as a business analyst, not a stock market speculator. You must be able to write down, in a single paragraph, why this is a good business and what a reasonable price to pay for it would be, completely independent of its current stock price. If you cannot do this, you have no business owning the stock. Step 5. Set your price and be patient. After your independent analysis, you will arrive at an estimate of the company's intrinsic value. The final step is to demand a, quote, margin of safety, another core Buffett principle. This means you will only buy the stock if its market price is significantly below your calculated intrinsic value. For example, if you determine a business is worth $100 per share, you might set your buy price at $70 or less. This margin of safety is your protection against errors in your own judgment and the unpredictable vicissitudes of the market. Then you wait. This is often the hardest part. The stock may continue to go up, away from your price, fueling your FOMO. It may trade sideways for years, or it may crash down to your price during a market panic. This discipline, setting a rational price and having the patience to wait for it, is the ultimate weapon against emotional investing. It turns the entire process from a reactive, emotional game into a proactive, business-like operation. This checklist is your shield against the madness of crowds. It is a systematic process for ensuring that every decision you make is your own, based on research and reason, not on social pressure and market sentiment. Now, let's explore the opposite path, the path of the 99% of investors who consistently underperform the market. This is the path of least resistance, the one your brain is naturally inclined to follow. It begins not with analysis, but with an emotion. Perhaps it's a headline on a website, a segment on a financial news show, or a conversation with a friend. Did you hear about XYZ stock? It's up 50% in the last month. The seed of FOMO is planted. The retail investor pulls up their brokerage app. They see the green, upward-sloping chart. The social proof is overwhelming. The price action confirms the story. They don't download the 10K. They don't know what a PE ratio is, or if they do, they dismiss it because this time is different. They tell themselves a story, borrowing the popular narrative. This company is the future of, insert industry here. They don't calculate intrinsic value. Their only calculation is how much money they could have made if they had bought last month, and how much they stand to make if the trend continues. Their risk management strategy is non-existent. It is pure hope. They click buy. For a while, it might even work. The stock continues to rise, validating their decision and giving them a hit of dopamine. This reinforces the bad behavior and gives them a false sense of confidence. They might even buy more, increasing their position size at an even higher, more dangerous valuation. They start giving tips to their other friends, becoming an evangelist for the stock and an active participant in the herd they joined. But bubbles, by their very nature, always pop. Eventually, the narrative shifts. Maybe the company misses an earnings estimate. Maybe a competitor emerges. Maybe the broader market simply runs out of steam. The stock begins to fall. At first, the investor is in denial. It's just a healthy pullback, they tell themselves. A great buying opportunity. They might even double down. A classic behavioral error known as, quote, anchoring to their original purchase price. But the stock keeps falling. The green on their screen turns to a sickening red. The euphoria is replaced by a knot of anxiety in their stomach. The news headlines are now negative. The same friends who were celebrating are now silent or panicking. The social proof that lured them in is now working in reverse, creating a stampede for the exits. Their initial thesis, which was never based on fundamentals, is shattered. All they have left is the pain of their mounting losses. Now, another powerful bias kicks in: loss aversion. The pain of losing money is psychologically twice as powerful as the pleasure of gaining an equivalent amount. This pain becomes unbearable. Their decision-making horizon shrinks from years to minutes. They aren't thinking about long-term wealth building. They are thinking about stopping the bleeding. Finally, near the bottom of the crash, when the fear is at its absolute peak and the narrative is one of doom, they capitulate. They click sell, locking in a devastating loss. The journey is complete. They bought at the peak of euphoria and sold at the trough of despair. They have perfectly executed the formula for destroying capital. This tragic cycle is the lived experience of millions of investors in every market generation. It's what happened with dot-com stocks in 2000, with housing in 2007, and with speculative tech and crypto assets in 2021. The names and the narratives change, but the underlying investor psychology is timeless. By succumbing to the herd, the retail investor willingly becomes the market's dumb money, providing liquidity for the disciplined, contrarian investors, the Buffetts of the world, who are calmly buying up their discarded assets at bargain prices. The financial connection here is not abstract, it is brutal and quantifiable. When you buy a stock in the grip of herd mentality, you are almost always overpaying. Let's translate this into the language of a balance sheet. A company's stock price can be expressed as a multiple of its earnings, its sales, or its book value. During a mania, these multiples expand to absurd levels. A solid, growing company might historically trade at 20 times its annual earnings, a P/E ratio of 20. During a bubble, a similar company with a more exciting story but weaker fundamentals might trade at 100 times earnings, or even have no earnings at all. What does this mean? It means that for every dollar of actual profit the business generates, you are paying 5 times more than you would for the boring established company. Your starting position is a massive handicap. For that investment to be successful, the company doesn't just have to grow. It has to grow at a truly miraculous, unprecedented rate for years, simply to justify the price you already paid. The odds of this are astronomically low. You have eliminated your margin of safety. In fact, you've done the opposite. You've built in a margin of disaster. Now consider the other side of the trade, Buffett's position. By being greedy when others are fearful, he is buying assets when their multiples are compressed. After the dot-com bubble burst, solid tech companies with real profits, like Microsoft and Oracle, were being sold off indiscriminately along with the worthless pets.coms of the world. An investor who had done their homework could buy these world-class businesses at P/E ratios of 15 or 20, a price that would have been unthinkable just a few years earlier. Their starting position is a massive advantage. The company doesn't need to perform miracles. It just needs to continue being a good business, and the investment will likely work out well. If the company does perform exceptionally, the returns will be spectacular because they benefit from both the company's earnings growth and as market sentiment normalizes. This single principle, buying when multiples are low, fear, and avoiding or selling when multiples are high, greed, is arguably the single most important factor in long-term portfolio growth. It directly impacts your compound annual growth rate, CAGR. A portfolio that consistently buys into euphoric markets might generate a CAGR of 2 to 3% over a decade, or even lose money. A portfolio that systematically avoids euphoria and patiently waits to buy during periods of fear can realistically achieve a CAGR of 12 to 15% or more over the long run. The difference is staggering. Over 30 years, a $10,000 investment growing at 3% becomes just $24,000. That same $10,000 growing at 12% becomes over $299,000. That is the direct financial consequence of mastering this one psychological bias. It is the mathematical bridge between a mediocre financial life and true financial freedom. It is the difference between being the sheep who gets sheared in every market cycle and the shepherd who profits from the predictable, irrational behavior of the flock. The second formidable enemy lurking in the investor's mind is the bias of overconfidence. This is the seductive belief that we are smarter, more talented, and have more control over events than we actually do. It is the hubris that whispers, "You've got this. You can beat the market, you can pick the winners and dodge the losers." In many areas of life, a healthy dose of confidence is essential for success. But in the world of investing, overconfidence is a lethal poison. It leads to 3 cardinal sins that systematically destroy wealth: excessive trading, concentrated and reckless bets, and the dismissal of risk. It transforms investing from a patient, humble enterprise into a high-stakes game of ego. A game that the market almost always wins. Warren Buffett's approach to the market is the antithesis of overconfidence. It is steeped in a profound and abiding humility, a concept he calls the circle of competence. This isn't just a folksy saying. It is a rigidly enforced mental model that has saved him from ruin countless times. To truly grasp its power, we must examine one of the most spectacular financial implosions in modern history, a story that Buffett watched from the sidelines, not with glee, but with the sober recognition of what happens when the brightest minds in the world forget the limits of their own intelligence, the collapse of long-term capital management. In the mid-1990s, a new hedge fund was formed that seemed like an investor's dream. It was called Long-Term Capital Management, or LTCM. Its founding partners were a collection of financial superstars. It included John Meriwether, the legendary former head of bond trading at Salomon Brothers, and two Nobel Prize-winning economists, Robert C. Merton and Myron Scholes, the architects of the Black-Scholes model for pricing options. They were, without exaggeration, considered the smartest guys in the room anywhere they went. Their strategy was complex, based on a type of arbitrage called convergence trading. They used sophisticated mathematical models to identify tiny, temporary pricing discrepancies between related securities around the world. For example, they might notice that a 29.5-year U.S. Treasury bond was trading at a slightly lower price than a 30-year Treasury bond. Their models told them that, over time, these prices should converge. They would then use massive amounts of borrowed money, leverage, to bet on this convergence. Each individual trade had a very high probability of success and a very small profit margin. But by using leverage of 25-to-1 or even 50-to-1, they could amplify these tiny profits into enormous returns. And for a while it worked like magic. From 1994 to 1997, LTCM delivered astonishing annual returns of over 40% after fees. They managed billions of dollars for the world's most sophisticated investors. They were hailed as financial geniuses who had created a money-printing machine, a fund that had supposedly figured out how to generate high returns with low risk. Their overconfidence was stratospheric. They believed their models had essentially solved the puzzle of the market. They saw risk not as a fundamental uncertainty, but as a statistical variable that could be precisely calculated and managed. Meanwhile, what was Warren Buffett doing? He was running Berkshire Hathaway with zero leverage at the parent company level. He was investing in businesses he understood deeply, like Coca-Cola and Gillette, businesses whose future earnings he could reasonably predict. He famously said of complex derivatives and financial engineering, "It's like when you're trying to zap a fly in the kitchen. You pick up the fly swatter and you walk around, and you wait, and finally you see him, and you sneak up, and you whap! But then you look, and you've also knocked over the lamp, and the vase, and the sugar." He understood that complexity introduces hidden, unpredictable risks. He was operating strictly within his circle of competence, which did not include quantitative arbitrage strategies based on Nobel Prize-winning formulas. He knew what he didn't know, and he refused to play in a game where he did not have a clear, demonstrable edge. In August 1998, the world changed. Russia defaulted on its domestic debt and devalued the ruble. This was a Six Sigma event, a statistical anomaly that LTCM's models had predicted would happen only once in thousands of years. But it happened. And it triggered a global flight to safety and liquidity. Investors around the world panicked and dumped all but the most liquid, safest assets, like 30-year U.S. Treasury bonds. The tiny price discrepancies that LTCM was betting on to converge did the exact opposite. They diverged violently. The 29.5-year bond they had bought went down in price, while the 30-year bond they had shorted went up. Because of their immense leverage, these small adverse movements created catastrophic losses. Every day, the fund was losing hundreds of millions of dollars. The smartest guys in the room were trapped. Their models were useless in a world gripped by fear. In the span of just a few weeks, long-term capital management lost $4.6 billion and was on the verge of a complete collapse that threatened to take the entire global financial system down with it. In a dramatic twist, the Federal Reserve Bank of New York had to orchestrate a massive $3.6 billion bailout from a consortium of Wall Street banks to prevent a chain reaction of defaults. Warren Buffett was actually called in as a potential participant in the bailout. He made a bid to buy out the entire portfolio for a steep discount, but the deal ultimately fell through due to timing issues. The episode stands as the ultimate parable of overconfidence. LTCM's partners were not stupid. They were brilliant. Their fatal flaw was not a lack of intelligence, but a lack of humility. They mistook their academic models for reality and failed to respect the market's infinite capacity for surprise. They strayed far outside any reasonable circle of competence, believing their intellect could conquer the inherent randomness and emotionality of markets. Buffett's decision to avoid such strategies was not a sign of intellectual deficiency, but of supreme intellectual discipline. He understood that the most important part of executive decision-making in investing is not knowing the answer to every question, but knowing which questions you can't possibly answer. His circle of competence philosophy is a direct assault on the demon of overconfidence, a humble admission that the world is far more complex and unpredictable than even the most brilliant mind can fully grasp. This humility is not a weakness, it is the ultimate risk management tool. The underlying psychological principles at play in the LTCM disaster are numerous, but they are all children of the parent bias, overconfidence. One of the key cognitive errors is the Dunning-Kruger effect, a bias where people with low ability at a task overestimate their ability, but also, crucially, where highly competent individuals can fail to recognize the limits of their competence, especially when they stray into a new domain. The Nobel laureates at LTCM were geniuses in the academic world of financial theory. They mistakenly assumed this genius would translate perfectly to the chaotic, real-world arena of trading. They confused theoretical knowledge with practical wisdom. Another critical bias is the illusion of control. This is the tendency for people to overestimate their ability to control events. The partners at LTCM believed their sophisticated computer models gave them control over risk. They saw the market as a machine that could be engineered and optimized, rather than as a complex adaptive system influenced by the unpredictable emotions of millions of human beings. They had a PhD in mathematics, but a kindergarten-level understanding of investor psychology. They failed to appreciate that in a panic, all correlations go to one. Investors sell what they can, not what they want to. Their finely tuned diversification models evaporated in the heat of a real crisis. Furthermore, they fell prey to what could be called intellectual authority bias. Because they were so highly credentialed and surrounded by other highly credentialed people, their ideas were rarely subjected to the kind of simple, common-sense skepticism that might have saved them. Who was going to challenge a Nobel Prize winner on his own theory? This created an intellectual echo chamber where their assumptions were reinforced rather than questioned. Buffett's circle of competence is a direct and powerful antidote to these biases. It is a mental framework built on the foundation of intellectual humility. It's not about how big your circle is, it's about knowing precisely where the perimeter lies. Buffett is famous for saying that he'd rather deal with a man with an IQ of 130 who thinks it's 125 than a man with an IQ of 180 who thinks it's 200. The first man knows his limits. The second is a walking time bomb. The circle of competence forces an investor to honestly assess their own knowledge. Do you truly understand this business? Can you explain, in simple terms, how it makes money and what its competitive advantages are? Could you explain it to a 10-year-old? If not, it's outside your circle. This isn't about avoiding technology or complex industries altogether. It's about being honest about whether you have put in the thousands of hours of work required to develop a genuine expertise. Buffett eventually did invest heavily in Apple, but only after years of studying the business, observing its ecosystem, and gaining a deep understanding of its brand power and customer loyalty. Factors that were well within his long-established circle of analyzing consumer franchises. He didn't need to understand the specifics of semiconductor design. He needed to understand the durability of Apple's competitive moat, and he waited until he did. This process is the polar opposite of the LTCM approach. It prioritizes deep, specific knowledge over broad, superficial intelligence. It respects the unknown and demands a margin of safety against it. It is the ultimate recognition that in investing, what you don't do is often far more important than what you do. How can the average person, who is not a full-time investor, apply this powerful mental model of the circle of competence to their own financial life? The blueprint involves a process of honest self-assessment and disciplined boundary setting. It is a practical guide to turning off the ego and turning on the rational mind. Step 1. Define your circle. This is an exercise in intellectual honesty. Take out a piece of paper and create 3 columns: expert, competent, and ignorant. Now, start listing industries, technologies, and business models. Be brutally honest with yourself. Perhaps you've worked in the retail industry for 20 years. You understand inventory management, consumer trends, and supply chains. Put retail in the expert column. Maybe you're a savvy consumer of software products and understand the basics of subscription models. Put software as a service in the competent column. What about biotechnology, complex derivatives, or currency trading? Unless you have specific, deep experience, those likely belong in the ignorant column. The goal here is not to feel bad about what you don't know, but to create a clear visual map of your own intellectual territory. This map is the foundation of your investment strategy. Your primary hunting ground for investments will be in the expert and competent columns. Everything in the ignorant column is off-limits for individual stock selection, period. Step 2. Create an ignorant portfolio strategy. What do you do with the majority of your capital if your circle of competence for individual stocks is small? You acknowledge your limitations and choose a strategy that doesn't require superior knowledge. This is where Buffett's advice for the average investor comes in. Buy a low-cost S&P 500 index fund. This is not a surrender. It is a profoundly intelligent strategic decision. By buying the index, you are admitting you don't know which of the 500 companies will be the winners, so you are buying all of them. You are harnessing the overall growth of American business without taking on the single stock risk that comes from straying outside your circle. This approach allows you to benefit from the genius of entrepreneurs in fields you don't understand, without having to pretend you're a genius yourself. For most people, this index fund should be the core of their portfolio management. Step 3. Cultivate your circle patiently. Your circle of competence is not static. It can be expanded. But it must be expanded through genuine learning, not wishful thinking. Choose one industry or company from your competent or ignorant list that interests you. Commit to studying it for at least a year before you invest a single dollar. Read the top 3 books on the industry. Read the annual reports for the last 5 years of the top 5 companies in that sector. Listen to their Investor Day presentations. Follow industry experts on social media. The goal is to move that topic from ignorant to competent, or competent to expert, through sheer force of effort. This patient, deliberate process of financial education is what separates professional investors from amateur speculators. It turns the stock market from a casino into a library. Step 4. Develop an anti-FOMO protocol. Overconfidence is often fueled by the fear of missing out on the next big thing. When a hot stock in an industry you don't understand is soaring, you need a pre-planned response. Your protocol could be this. When you feel the urge to buy a stock outside your circle, you must immediately take 2 actions. First, write down the reason why you want to buy it. Is it because of a compelling story, because everyone is talking about it, or because of a deep analysis of its financials? Be honest. Second, for every dollar you are tempted to invest in that speculative stock, you must put an equal amount into your boring, core S&P 500 index fund. This acts as a sin tax on speculation. It forces you to balance your high-risk gamble with a prudent, disciplined investment, dampening the potential for catastrophic error and reminding you of your long-term strategy. This 4-step mental model provides a practical framework for any retail investor. It grounds your decisions in what you actually know, provides a sensible default for what you don't, creates a path for disciplined learning, and builds a defense mechanism against your own worst, most overconfident impulses. It is the operating system for rational wealth building. Now let's examine the antithesis, the well-trodden path of the overconfident retail investor. This journey almost always begins with a small victory. Perhaps they got lucky on a speculative stock, or maybe they just started investing during a bull market where everything was going up. This initial success is misinterpreted. Instead of attributing it to luck or a favorable environment, they attribute it to their own superior skill. The Dunning-Kruger effect takes hold. This newfound confidence leads to the first cardinal sin, overtrading. They start to see the market as a place to make moves, not a place to own businesses. They check their portfolio constantly, watching the minute-by-minute ticks of the stocks they own. They subscribe to trading services, watch financial news breathlessly, and believe they can predict short-term market movements. The data on this is unequivocal. The more an individual investor trades, the worse their returns are. Transaction costs and taxes eat away at their gains, and their attempts at market timing inevitably lead them to sell low and buy high. The second sin is a direct consequence of the first: concentration and a disregard for diversification. Believing they have a special insight, they start making bigger and bigger bets on single ideas. They might put 25% or even 50% of their portfolio into one can't-miss stock they heard about online. Their portfolio, which should be a well-structured asset allocation designed for long-term growth and capital preservation, devolves into a collection of high-risk lottery tickets. They dismiss the wisdom of diversification as something for boring investors who lack their vision and courage. They have no concept of risk management. Their only focus is on the potential upside. The final sin is the refusal to admit mistakes. When one of their high-conviction bets starts to go wrong, their ego prevents them from cutting their losses. Admitting the mistake would be an admission that their initial analysis was flawed, a direct blow to their overconfident self-image. So they hold on, and often they double down. They engage in motivated reasoning, seeking out any piece of information that confirms their original thesis and ignoring the mountain of evidence that contradicts it. The stock falls from $100 to $80. It's on sale, they say. It falls to $50. The market is irrational, they insist. It falls to $20. They either continue to hold, paralyzed by the massive loss, or they finally sell in disgust, having wiped out a huge portion of their capital. This story is the tragic biography of countless brokerage accounts. It is the inevitable result of letting ego, rather than humility, guide your decision-making. The overconfident investor believes they are the master of their own destiny, able to outsmart the collective wisdom of the market. In reality, they are a puppet, with their strings being pulled by the cognitive biases of their own mind. They are their portfolio's worst enemy, actively steering it towards the rocks while confidently proclaiming they have discovered a shortcut to the promised land. The direct financial connection between overconfidence and poor returns is devastatingly clear and can be seen directly on an investor's statement. The most direct impact comes from the cost of excessive trading. Every time you buy or sell a stock, you incur costs. There are explicit costs, like commissions, though many brokerages now offer zero-commission trades, and more importantly, there are implicit costs, like the bid-ask spread. This is the small difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. For frequently traded stocks, this is small, but for less liquid ones, it can be significant. Over hundreds of trades, these small costs add up, creating a constant drag on your performance. More damaging still are the tax implications. When you hold a winning investment for more than a year, your profit is taxed at the lower long-term capital gains rate. When you buy and sell in less than a year, your profit is taxed as ordinary income, which is a much higher rate for most people. Overconfident day traders are constantly resetting their tax clock, turning a large portion of their potential gains over to the government. A landmark study by Professors Barber and Odean titled "Trading is Hazardous to Your Wealth" analyzed the accounts of thousands of retail investors. Their conclusion was stark. The investors who traded the most earned an annual return that was a full 7 percentage points lower than the overall market. This is a direct, quantifiable wealth destruction event caused purely by overconfidence. Beyond trading costs, the financial impact of poor risk management is even more severe. By making large, concentrated bets, the overconfident investor exposes their portfolio to the risk of permanent capital loss. A diversified portfolio can easily recover from one of its holdings going to zero. A portfolio with 50% of its assets in that same stock is crippled for a generation. The mathematics of loss are unforgiving. If you lose 50% of your capital, you need to gain 100% just to get back to even. The overconfident investor who takes a huge loss on a speculative bet has not just lost money, they have lost their most valuable asset, time, and the power of compounding. By contrast, Buffett's humble, circle of competence approach has a direct and powerful positive effect on his long-term returns. By minimizing trading, he minimizes costs and taxes. By waiting for years, even decades, before selling a great business, he allows the miracle of compounding to work its magic uninterrupted. By refusing to invest in things he doesn't understand, he avoids the catastrophic blow-ups like LTCM that wipe out less disciplined investors. His strategy is designed for capital preservation first and growth second. This might seem less exciting, but it is mathematically superior over the long run. The financial advantage doesn't come from hitting home runs every year. It comes from studiously avoiding strikeouts. It is the steady, relentless application of a disciplined process that respects risk and acknowledges the limits of human knowledge, a process that slowly but surely builds one of the world's greatest fortunes. The third great psychological battle an investor must win is against the primal fear of loss. Deep within our brains, we are programmed by a powerful bias known as loss aversion. Decades of research in behavioral finance, most notably by psychologists Daniel Kahneman and Amos Tversky, have proven that the psychological pain of losing $1 is roughly twice as intense as the pleasure of gaining $1. This asymmetry is a relic of our evolutionary past. For an early human living on the edge of survival, the loss of a day's food was a far more significant event than the gain of an extra day's food. Losing could mean death, while gaining just meant a full stomach. This instinct is now embedded in our neural circuitry. In the stock market, this hardwiring is a disaster. It causes investors to engage in two profoundly self-destructive behaviors: selling their winning investments far too early and holding on to their losing investments for far too long. They sell their winners early to lock in the small pleasure of a gain and avoid the potential future pain of that gain disappearing. They hold their losers indefinitely, because selling would mean crystallizing the loss, forcing them to confront the intense psychological pain of being wrong. This leads to portfolios full of withered weeds and a few plucked flowers. Warren Buffett's career is a masterclass in inverting this destructive tendency. He is ruthless about cutting businesses that are deteriorating, but he is almost infinitely patient with his winners. His mantra is that his, quote, favorite holding period is forever. This isn't just a clever line, it's a strategic exploitation of the market's collective loss aversion. To see this principle in action, we must journey back to a time of immense turmoil and fear, a time when one of America's most iconic brands was on the brink of collapse, and everyone was panicking, except for a young investor from Omaha, the story of Buffett's investment in American Express during the Salad Oil scandal. In the early 1960s, American Express was a Wall Street darling. It was seen as a blue-chip, utterly reliable company. Its main businesses were its travelers' checks and charge card operations, which were immensely profitable. But it had another, less glamorous division, a warehousing unit. This unit would inspect a company's inventory, like barrels of oil or tons of steel, and then issue receipts against that inventory. Other banks would then lend money to the company with those receipts as collateral. It was a boring but steady business. One of American Express's biggest warehousing clients was the Allied Crude Vegetable Oil Refining Corporation, a company run by a charismatic but cunning man named Tino DeAngelis. Allied was a major exporter of vegetable oils, and it used American Express's warehousing receipts to secure massive loans. In November of 1963, the scandal broke. It was discovered that DeAngelis was a master fraudster. His giant tanks, which were supposed to be full of valuable salad oil, were mostly full of seawater, with only a thin layer of oil floating on top. He had created a massive Potemkin village of phantom inventory. When the fraud was uncovered, Allied Crude Vegetable Oil immediately went bankrupt, defaulting on over $150 million in loans, a colossal sum at the time. The banks who had made the loans, holding what they thought were ironclad American Express receipts, turned to Amex for payment. Wall Street panicked. No one knew the extent of American Express's liability. Would the company be forced to cover all the fraudulent loans? Would the scandal destroy the public's trust in its core traveler's check business, the crown jewel of the company? The market sentiment was overwhelmingly negative. Analysts and pundits predicted bankruptcy. The herd was stampeding for the exits. American Express stock, which had been trading at over $60 a share before the crisis, plummeted by nearly 50%, bottoming out around $35. This was a moment of pure, unadulterated fear. The pain of loss was palpable. Every headline screamed of disaster. For the average investor, the instinct would have been to sell at any price to avoid further losses. Their loss aversion would have been screaming at them to get out. But this is where Warren Buffett's rational mind saw not a crisis, but an opportunity. Instead of panicking, he began a deep, methodical investigation. He didn't just read the newspaper reports, he engaged in what is now called scuttlebutt research. He went out into the real world to see if the scandal was affecting American Express's fundamental business. He visited restaurants and banks. He talked to cashiers and tellers. He would buy travelers' checks with cash, wait a bit, then go to a different bank and cash them in, observing the process. He was asking a simple question: was the public losing faith in the American Express brand? He discovered the opposite. He saw that customers were still using the charge cards. Businesses were still happily accepting them. And most importantly, banks and consumers still treated the traveler's checks like cash. The brand's competitive moat, the deep well of trust it had built over decades, was completely intact. The fear on Wall Street was completely detached from the reality on Main Street. Buffett then dug into the financials. He concluded that while the company would face significant legal liabilities from the scandal, its powerful core earnings from the card and traveler's check businesses were so strong that it could easily absorb the hit. The market was pricing the company for bankruptcy, but the underlying business was still a money-printing machine. He calculated that the temporary salad oil problem was masking the value of a phenomenal, enduring enterprise. Convinced by his independent research, Buffett made a bold, contrarian move. Between 1964 and 1966, he invested a staggering 40% of his investment partnership's capital into American Express stock, buying it at its moment of maximum pessimism. It was a massive, concentrated bet. Over the next few years, as the company settled the legal claims and its powerful earnings engine continued to churn, the market's fear subsided. The stock price recovered and then soared. Buffett's investment more than quadrupled in value, turning a $13 million position into well over $50 million, and cementing his reputation as a brilliant contrarian investor. This story is the perfect illustration of overcoming loss aversion. While the rest of the market was consumed by the pain of short-term losses and the fear of what might happen, Buffett was calmly and rationally assessing the long-term value of the business. He was greedy when others were fearful, not as a gamble, but as a calculated decision based on deep research that proved the market's emotional reaction was wildly exaggerated. He turned the market's pain into his portfolio's gain. The psychological foundation for the disastrous behavior that loss aversion creates is laid out in prospect theory, the groundbreaking work that won Daniel Kahneman the Nobel Prize in Economics. Prospect theory describes how people make decisions under uncertainty, and its central insight is that our choices are not based on absolute outcomes, but on the potential for gains and losses relative to a reference point, usually our starting position. The theory is often illustrated with a simple value function graph. In the domain of gains, the curve is concave, meaning that each additional dollar of gain provides less and less additional pleasure. The difference between gaining $0 and $100 feels much larger than the difference between gaining $1,000 and $1,100. Conversely, in the domain of losses, the curve is convex and much steeper. This means that each additional dollar of loss hurts more and more, and the initial pain of losing that first $100 is far more potent than the pleasure of gaining $100. This kinked, asymmetric value function is the mathematical representation of loss aversion. It explains why holding losers and selling winners feels so natural. When a stock you own goes up, it moves you into the domain of gains. By selling, you realize that gain, converting the paper profit into a concrete, pleasurable event. Because the gain curve is concave, you are eager to lock in this pleasure before it can slip away and potentially turn into a painful loss. You are trading a large potential future gain for a small, certain present gain because it feels emotionally safer. When a stock you own goes down, it moves you into the domain of losses. Your reference point is the price you paid. Selling the stock for less than you paid forces you to officially accept the loss, an intensely painful psychological event. Because the loss curve is convex and steep, you will do almost anything to avoid this. So you hold on, telling yourself, "I'll sell it when I get back to even." This is a completely irrational statement from a financial perspective. The market doesn't care what price you paid. The only relevant question is, based on today's information, is this the best possible place for my capital? But your loss-averse brain can't think that way. It's fixated on erasing the loss, on getting back to that neutral reference point. This leads to what is known as the disposition effect, the statistically verified tendency of investors to sell winning assets while holding on to losing assets. Buffett's entire investment philosophy is a system designed to short-circuit this irrational behavior. His forever holding period for winners is a direct countermand to the urge to sell early. He understands that the vast majority of a portfolio's long-term returns often come from a very small number of spectacular winners. His investment in Coca-Cola, which he has held for over 30 years, is a prime example. Had he sold it after it doubled, a move his loss-averse instincts might have encouraged, he would have missed out on literally tens of billions of dollars in subsequent gains and dividends. His approach to losers is equally rational. He and Charlie Munger often talk about the importance of being able to destroy a previously cherished idea. If the facts change, if a company's competitive advantage erodes, they are willing to take the loss and move on, redeploying the capital to a more promising opportunity. They are not anchored to their original purchase price. They are forward-looking, constantly re-evaluating based on future prospects, not past mistakes. This requires a level of emotional detachment and intellectual honesty that is exceedingly rare, but it is absolutely essential for superior portfolio management. How does a retail investor build a mental model to defeat their own powerful hardwired loss aversion? The key is to create systems and pre-commitments that take the emotional decision-making out of the equation during moments of stress. This blueprint is an emotional pre-commitment contract. Step 1. Write a pre-mortem for every investment. Before you buy a single share of a stock, you must perform a pre-mortem, an exercise imagined by psychologist Gary Klein. Assume it's 1 year from now, and this investment has been a complete disaster. Now write down the story of why it failed. What went wrong? Did a new competitor emerge? Did the company's product become obsolete? Did management make a series of terrible capital allocation decisions? This exercise does two things. First, it forces you to confront the potential for loss before you are emotionally invested, making the prospect of a future loss less shocking and painful. Second, it creates a list of concrete red flags. This list will become your sell criteria. Step 2. Define your sell criteria in advance. Based on your pre-mortem, you now create a written contract with yourself. This contract will state the specific, objective conditions under which you will sell the stock. These cannot be based on the stock price. They must be based on the fundamentals of the business. For example, I will sell my shares in Company X if A. Its market share in its core product line declines for 2 consecutive years, B. It makes a major acquisition outside of its circle of competence, or C. Its debt-to-equity ratio rises above 3.0. This contract must be written down when you are calm and rational. It is your instruction manual for your future, emotional self. When the stock is down 40% and you are panicking, you don't have to think, you just have to consult the contract. Have any of the sell criteria been met? If yes, you sell, regardless of the loss. If no, you hold, or perhaps even buy more, because the price decline is likely due to market sentiment, not a deterioration of the business. Step 3. Implement a winners holding rule. To combat the urge to sell winners too early, you need a rule to force patience. A simple but effective rule is the 5-year rule. For any stock that you buy, you pre-commit to not selling it for at least 5 years, unless one of your fundamental sell criteria from the pre-mortem is triggered. This forces you to think like a long-term business owner, not a short-term stock trader. It gives the company time to execute its strategy and allows the power of compounding to begin working its magic. It prevents you from snatching a small profit out of fear and missing out on a 10-bagger. Knowing you are locked in for the long haul also dramatically raises the bar for your initial purchase decision, improving the overall quality of your portfolio. Step 4. Automate your investing. The single best way to overcome emotional decision-making is to remove decisions altogether. Set up an automatic investment plan that contributes a fixed amount of money from every paycheck into your core, low-cost index fund. This is dollar-cost averaging. When the market is high, your fixed dollar amount buys fewer shares. When the market is low and fear is rampant and your loss-averse brain would be telling you to stop investing, your fixed dollar amount automatically buys more shares. This simple automation turns your loss aversion on its head. It ensures you are systematically greedy when others are fearful, without requiring any emotional fortitude whatsoever. It is the ultimate behavioral finance life hack. This 4-part contract is a system for imposing discipline on your future self. It replaces whim with process and emotion with rules. It is the practical application of Buffett's rational detachment, scaled down for the retail investor who is fighting a daily battle with their own worst instincts. Let's trace the path of the 99% who are ruled by loss aversion. Their portfolio becomes a sad museum of past mistakes. It starts with the purchase of a stock, often based on a flimsy thesis. The stock then falls. Let's say it drops 20%. The investor's brain immediately recoils from the pain. The thought of selling and locking in that 20% loss is unbearable, so they rationalize. It's a long-term hold, they tell themselves, even if their initial intention was a short-term trade. The market is just being irrational, it will come back. The stock then falls to a 40% loss. Now the pain is even more intense. Selling now feels like a catastrophic failure, an admission of terrible judgment. The desire to just get back to even becomes an obsession. They are now completely anchored to their purchase price, a number that is totally irrelevant to the stock's future prospects. This is the point where good money often follows bad. They might even buy more of the stock, not because a rational analysis suggests it's a better value now, but because it averages down their cost basis. This is a purely psychological maneuver to reduce the psychic pain of the original purchase price. It's like a gambler increasing their bets to win back their losses, a strategy that almost always ends in ruin. While this is happening with their losers, the opposite is happening with their winners. A stock they bought goes up 30%. The pleasure is nice, but it's mixed with a growing anxiety. What if it goes back down? The fear of that gain turning into a loss becomes overwhelming. They can't stand the thought of giving back their profits, so they sell, locking in the small, safe gain. They feel smart and prudent. A year later, that same stock has tripled. They missed the lion's share of the gains because their fear of a small loss was greater than their desire for a large gain. Over time, this process creates a disastrously lopsided portfolio. The process of natural selection is inverted. Instead of the strong surviving and the weak being culled, the weak and sickly stocks are nurtured and allowed to grow into huge positions of dead money, while the strong, healthy, growing stocks are cut down in their youth. The investor's portfolio becomes an anti-S&P 500, a collection of the market's worst-performing, fundamentally broken businesses. They have perfectly executed a strategy for ensuring long-term underperformance. This is not because they are unintelligent, but because they are human. They have allowed a primal, evolutionary instinct, unchecked by a rational system, to wreak havoc on their financial decision-making, turning a tool for wealth building into an engine of self-sabotage. The direct financial connection of loss aversion is a story of compounding failure on the losing side and compounding opportunity cost on the winning side. Let's quantify it. Imagine an investor with a $100,000 portfolio split into 10 $10,000 positions. One of these positions is in a company whose business model is failing. It falls 50% to a value of $5,000. Paralyzed by loss aversion, the investor holds on. The company eventually goes bankrupt. The financial result is a permanent capital loss of $10,000. That's a 10% hit to their entire portfolio from a single position they refused to sell. Now consider another position in the same portfolio. This one is a fantastic company that doubles in value to $20,000. Anxious to lock in the gain, the investor sells. They've made a $10,000 profit. This feels great. But the company continues to be fantastic. Over the next decade, it grows tenfold from the point where they sold. Their $20,000 position would have become $200,000. The financial result is an opportunity cost of $180,000. The $10,000 gain they celebrated pales in comparison to the life-changing wealth they forfeited. When you multiply this across a whole portfolio over an investing lifetime, the numbers become astronomical. The portfolio of the loss-averse investor is constantly being dragged down by the dead weight of its losers and is never able to achieve escape velocity because its winners are sold before they can truly compound. Now look at the Buffett model. By holding on to his winners like Coca-Cola, See's Candies, and American Express for decades, he allowed them to compound capital at high rates of return for enormous periods of time. A single great decision, protected from the emotional urge to sell, can generate more wealth than hundreds of mediocre trades. The numbers on his Coca-Cola investment are legendary. He invested about $1.3 billion in 1988-1989. By the end of 2022, that position was worth over $25 billion, not including the cumulative dividends he had received over 34 years. In 2022 alone, Berkshire received over $700 million in dividends from Coca-Cola, which is more than 50% of his original purchase price, received in a single year, every year. This is the almost unimaginable financial power that is unlocked when you defeat loss aversion. It allows you to harness the eighth wonder of the world, compound interest, to its absolute fullest potential. It transforms your portfolio from a leaky bucket into a fortified reservoir of ever-expanding capital. The financial difference between the two approaches is not a matter of degree. It is a matter of destiny. It is the difference between a lifetime of frustrating mediocrity and the creation of lasting generational wealth. The fourth psychological hurdle that trips up the vast majority of investors is a powerful temporal distortion in our thinking known as recency bias. This is our natural tendency to give greater importance to recent events than to historic ones. We extrapolate the immediate past into the indefinite future. If the market has been going up for the last year, our brain assumes it will continue to go up. If the market has just crashed, our brain convinces us it's going to zero. This short-term focus, this mental myopia, is the engine of market manias and panics. It causes investors to be most bullish at the very top of the market, right after a long period of positive returns, and most bearish at the very bottom, right after a painful crash. It's the perfect recipe for buying high and selling low. Warren Buffett's entire operational philosophy is a rebellion against this short-termism. His famous quote, "The stock market is a device for transferring money from the impatient to the patient," is a direct critique of recency bias. He cultivates an exceptionally long-term perspective, famously evaluating investments based on his ability to project their earnings a decade or more into the future. To witness this principle in its most potent form, we must return to the fall of 2008. The world was in the grips of the most terrifying financial crisis since the Great Depression. The global financial system was on the verge of complete meltdown. The recency bias was overwhelming and entirely negative. Every day brought news of another bank failure, another government bailout, another precipitous drop in the stock market. The fear was absolute. And in the middle of this chaos, Warren Buffett embarked on one of the most audacious and profitable investment sprees in history. September 2008 was a month of pure financial terror. On September 15th, Lehman Brothers, a 158-year-old investment bank, declared bankruptcy, sending shockwaves through the global system. The next day, the insurance giant AIG required a massive federal bailout to avoid collapse. The credit markets froze. Banks stopped lending to each other. The Dow Jones Industrial Average was in free fall, plummeting day after day. The dominant narrative, amplified by a 24/7 news cycle, was one of unmitigated disaster. The most recent and vivid evidence available to every investor was of catastrophic failure and loss. The instinct to sell everything, to convert all assets to cash and hide under the bed, was overwhelming. Investor psychology had swung from the greed of the housing bubble to the absolute extreme of fear. It was in this precise environment that Warren Buffett's phone started ringing. The world's most powerful financial institutions were not calling him for advice, they were calling him for a lifeline. Goldman Sachs, the most prestigious investment bank on Wall Street, was facing a crisis of confidence. Despite being in better shape than its rivals, the market was treating it as toxic. Its stock price was collapsing. Its CEO, Lloyd Blankfein, made a desperate call to Omaha. The result was a masterstroke of financial and psychological genius. On September 23, 2008, Buffett agreed to invest $5 billion into Goldman Sachs. But this wasn't a simple stock purchase. Buffett negotiated a spectacular deal. He received $5 billion worth of preferred stock that paid him a 10% annual dividend, a staggering $500 million a year in cash. On top of that, he received warrants giving him the right to buy another $5 billion worth of Goldman's common stock at a fixed price of $115 per share at any time in the next 5 years. At the time, the stock was trading around $125, but it would fall much further in the coming months. The deal was a massive win for Buffett, providing him with huge downside protection. The preferred shares were safer than common stock, and enormous upside potential, the warrants. But its most important effect was psychological. The news that the world's most trusted investor was putting his own money and his priceless reputation behind Goldman Sachs was a thunderclap of confidence in a market devoid of it. It was the ultimate signal that the panic was overdone. A few weeks later, he did it again. He invested $3 billion in General Electric, another blue-chip giant teetering on the brink on similarly favorable terms. He was not just investing. He was selling courage when it was the scarcest commodity on earth. Then, on October 16, 2008, with the market still in turmoil, he published an op-ed in the New York Times titled, "Buy American I Am." In it, he laid out his thesis with stunning clarity. He acknowledged the terrible headlines and the fear everyone was feeling. "The financial world is a mess," he wrote, but then he pivoted, directly attacking recency bias. He reminded readers that America had faced worse crises, the Civil War, the Great Depression, World War II, and had always emerged stronger. He stated that a simple rule had guided his own buying: be fearful when others are greedy, and be greedy when others are fearful. He announced that he was moving his personal cash reserves out of Treasury bills and into American stocks. He admitted he had no idea if the market would be lower in a month or a year, but that it would almost certainly be higher in 5 or 10 years. This was the ultimate long-term perspective, a direct rejection of the tyranny of the present moment. While the world was fixated on the terrifying events of the past few weeks, Buffett was focused on the enduring earning power of American business over the next few decades. His actions and his words were a clinic in overcoming recency bias. He was using the short-term panic of others, fueled by their myopic focus on recent events, to acquire stakes in world-class businesses at prices that would have been unimaginable just a year earlier. The Goldman Sachs investment alone would net Berkshire Hathaway a profit of over $3 billion. His broader portfolio, which he was adding to during the crisis, would go on to generate staggering returns as the market recovered. He demonstrated that the greatest financial opportunities are not born in times of comfort and optimism, but in the depths of despair and short-sighted panic. The psychological principle underpinning this market myopia is a combination of recency bias and the availability heuristic. The availability heuristic is a mental shortcut where we judge the likelihood of an event based on how easily examples of it come to mind. In the fall of 2008, examples of financial collapse were not just easy to come to mind, they were a constant, blaring presence. Lehman Brothers, AIG, Bear Stearns. These recent, vivid, and emotionally charged events became the data points our brains use to forecast the future. The historical data of a century of market recoveries and economic growth became abstract and distant, while the fresh memory of the crash felt immediate and predictive. Recency bias is the temporal component of this. Our brains are not wired to give equal weight to all information across time. We are prisoners of the present. The information we have received in the last day, week, or month feels more relevant and true than the lessons of the last decade or century. This is likely another evolutionary holdover. For our ancestors, the location of a predator seen 10 minutes ago was far more important than the location of a fruit tree seen last season. This focus on the immediate was a survival trait. In long-term investing, it is a catastrophic flaw. It creates a perpetual pro-cyclical behavior pattern. During a bull market, every month brings positive returns. The most available and recent information is all good news. This leads to overconfidence and a belief that the good times will last forever, causing investors to pile in at the top. During a bear market, every month brings negative returns. The most available and recent information is all bad news. This leads to despair and a belief that the losses will never end, causing investors to sell out at the bottom. Buffett's mind is disciplined to operate on a different timescale. He achieves this through several cognitive techniques. First, he is a voracious student of history. He has read hundreds of business and financial biographies and histories. His mind is not just filled with the events of the last quarter, it is filled with the patterns of the last century. He has studied the panics of 1873, 1907, and 1929. This deep historical context acts as a powerful antidote to recency bias. It allows him to see the current crisis not as an unprecedented apocalypse, but as another chapter in a long, cyclical story of human fear and greed. He has seen this movie before and knows how it ends. Second, he focuses on incredibly stable, predictable businesses. When he analyzes Coca-Cola, he isn't trying to guess its earnings next quarter. He is thinking about how many servings of Coke will be consumed by the global population in 10 years. This type of long-range forecasting forces his brain out of the short-term news cycle and into a different analytical framework. He is playing a different game on a different time horizon than almost every other market participant. This is not an innate gift, it is a learned discipline. He has intentionally trained his brain to zoom out, to see the big picture, and to give more weight to the durable, long-term trends than to the frantic, short-term noise. This is the essence of a superior investment mindset. How can a retail investor develop this time traveler's perspective and build a mental model to defeat recency bias? The blueprint is a decade horizon decision framework, a system designed to force a long-term view on every investment choice. Step 1. Adopt a time-weighted news diet. You must consciously manage your information intake to fight recency bias. For every hour you spend consuming up-to-the-minute financial news, like watching CNBC or scrolling through market news on your phone, you must spend at least 1 hour consuming long-form historical content. This could be reading a business biography, a book on a past market crash, or even Berkshire Hathaway's annual shareholder letters. This balances the scales. It ensures that your brain is being fed with as much long-term context as it is with short-term noise. This simple habit will slowly but surely recalibrate your mental timeline, making you less susceptible to the emotional whims of the daily news cycle. Step 2. For every buy/sell decision, write a letter to your future self. When you are considering a major portfolio change, especially during a period of market turmoil, you must engage in a writing exercise. Take out a pen and paper and write a letter dated 10 years in the future. In this letter, you must explain to your future self why you are making this decision today. For example, if you are panic selling during a crash, you must write, "Dear future me, today is October 26th, 202x. The market is down 30% and I am selling all my stocks. I am doing this because the specific fears and headlines of the day. My belief is that these short-term events will permanently impair the long-term earning power of these businesses." Conversely, if you are buying during that same crash, you would write, "Dear future me, I am buying today because while the headlines are scary, I believe that in 10 years the fundamental value of these great businesses will be much higher than their current fear-driven prices." This simple act of writing forces you to justify your decision based on a 10-year outlook. It often exposes the absurdity of making a permanent decision based on a temporary emotion. It is a powerful tool for injecting long-term reason into a short-term emotional process. Step 3. Create a portfolio quarantine period. When a new major event happens, a market crash, a sudden recession, a geopolitical crisis, make a hard rule that you are not allowed to make any major changes to your portfolio for a fixed period, say 30 days. This is a mandatory cooling-off period. It prevents you from making a knee-jerk reaction based on the initial, emotionally charged news. It gives you time to digest the information, to see how events unfold, and to consult your long-term plan. The market might be lower in 30 days, or it might be higher. The point isn't to time the bottom, but to prevent yourself from acting on pure, unfiltered, recency-biased panic. Step 4. Focus on input, not output. Recency bias thrives on our obsession with short-term results, the daily and monthly fluctuations of our portfolio's value. To break this, you must shift your focus from the output, the portfolio value, to the input, your savings rate and investment process. Instead of checking your portfolio value every day, check it once a quarter. But every single month, track your savings rate. Are you consistently putting money away? Are you following your automated investment plan? Celebrate the consistency of your process, not the randomness of the market's short-term movements. You cannot control the market's output, but you have absolute control over your own input. By focusing on what you can control, your savings and your discipline, you starve recency bias of the emotional fuel it needs to survive. This framework systematically pulls your perspective away from the present moment and anchors it in the deep past and the distant future. It is a training program for your brain, teaching it to ignore the siren song of the immediate and focus on the enduring principles of long-term wealth building. Now we must look at the opposite approach, the path of the investor who is a slave to recency bias. This investor's portfolio is a perfect chronicle of the market's recent fads and fears. In a bull market, their behavior is predictable. After several years of strong returns, their skepticism wanes and is replaced by optimism, then greed. The recent past has been profitable, so they assume the future will be as well. They increase their allocation to stocks, often taking on more risk than they are comfortable with. They start buying the hot stocks and sectors that have had the best recent performance, a strategy known as chasing winners. They are buying not based on valuation but purely on momentum. Their portfolio in early 2000 would have been heavily weighted towards tech stocks. In 2007, it would have been full of housing and financial stocks. In 2021, it would have been loaded with speculative growth, crypto, and meme stocks. They are perfectly positioned for the eventual downturn. Then the crash comes. The first 10% drop is dismissed as a blip. But as the losses mount, the positive recent memories are replaced by painful ones. The availability heuristic kicks in. All they can think about is the money they've lost in the last few weeks. They extrapolate this recent pain into the future, imagining a scenario of endless losses. The fear becomes unbearable. They capitulate and sell, often near the bottom of the market. Their justification is that they are moving to cash to wait until there is more clarity. This is a classic recency bias trap. They are waiting for the recent negative news to be replaced by recent positive news before they get back in. The problem is that by the time the news is clearly positive, the market has already recovered significantly. They end up selling low, and if they ever get the courage to get back in, buying high. This cycle of performance chasing and panic selling ensures they capture the majority of the market's downside and miss out on a large portion of its upside. It is a mathematically guaranteed path to underperformance. Their portfolio is not a tool for building wealth. It is a vehicle for emotional expression, whipsawed by the prevailing mood of the last 6 months. They are not investing. They are simply reacting, always one step behind the market, perpetually mystified as to why their returns are so poor while their timing feels so right in the moment. The financial connection between recency bias and portfolio destruction is profound. Let's quantify the cost of missing the recovery. A study by J.P. Morgan Asset Management analyzed the 20-year period from 2003 to 2022. During this time, the S&P 500 delivered an annualized return of 9.8%. However, if an investor missed just the 10 best days in the market over that entire 20-year period, roughly 5,000 trading days, their return dropped to just 5.5%. If they missed the 20 best days, their return fell to 2.6%. And if they missed the 30 best days, their return was a paltry 0.3%. The devastating truth is that the market's best days often come in very close proximity to its worst days, usually during periods of extreme volatility and fear, precisely when the recency-biased investor has sold out and moved to cash. By selling in a panic, you are not just locking in a loss, you are dramatically increasing the probability that you will miss the powerful recovery that inevitably follows. This is not a small rounding error in your wealth-building plan. It is the entire ballgame. Consider Buffett's actions in 2008. By investing during the panic, he ensured he was fully invested before the market's best days arrived. When the market finally turned in March of 2009, it did so with breathtaking speed. In the 3 months from March to May 2009, the S&P 500 rallied over 35%. The investor who was waiting for clarity missed this entire move. They were waiting for the recent data to look good, but the good returns happened long before the economic data or the headlines improved. The financial cost is the massive, permanent gap between the returns of the patient investor and the impatient one. The patient investor who rides out the storm captures the full 9.8% long-term return. The impatient, recency-biased investor who panics and misses a few key days ends up with a bond-like return from their equity portfolio, taking all the risk for none of the reward. This is the direct, quantifiable tax that recency bias imposes on a portfolio. It is a self-inflicted wound that turns the powerful engine of equity compounding into a sputtering, inefficient machine, all because the investor chose to navigate by looking only at the last few feet of the road behind them. The fifth and final psychological demon that an investor must vanquish is perhaps the most insidious, as it masquerades as intelligence and diligence. It is confirmation bias, the tendency to search for, interpret, favor, and recall information in a way that confirms or supports one's pre-existing beliefs or hypotheses. Once we have formed an opinion that a certain stock is a great investment, for example, our brain subconsciously begins to act not as an objective scientist, but as a biased lawyer. It selectively gathers evidence that supports its case while ignoring or discrediting any evidence that contradicts it. This creates a dangerous intellectual cocoon, a feedback loop of self-validation that makes us double down on our ideas, especially when they are wrong. It prevents us from seeing the world as it is, and instead locks us into a view of the world as we want it to be. Warren Buffett's entire research process is a structured war against this bias. He doesn't seek to prove himself right, he actively seeks to prove himself wrong. Charlie Munger describes their approach succinctly: it's the mark of a brilliant mind to be able to destroy its own best-loved ideas. This process of intellectual honesty and rigorous self-criticism is a cornerstone of their success. To see this in practice, we can look at one of Buffett's earliest and most successful major investments, a case where the prevailing market narrative was overwhelmingly negative, but his objective, unbiased research revealed a hidden gem: his investment in the Washington Post. In the early 1970s, newspaper stocks were deeply out of favor on Wall Street. The consensus view was that they were a dying industry. The rise of television news was seen as an existential threat, and investors wanted nothing to do with these old media dinosaurs. The Washington Post Company, which had recently gone public in 1971, was no exception. Its stock price languished. The market was looking at the headline risk and the negative narrative and confirming its own bearish thesis. But in 1973, a 43-year-old Warren Buffett started looking at the company, not through the lens of the popular narrative, but through the cold, hard lens of business economics. He wasn't looking for articles that confirmed newspapers were dying. He was asking a different set of questions. He started by analyzing the competitive landscape. He saw that in most major cities, the newspaper business was a natural monopoly or duopoly. A city could support one or two dominant papers, but a third or fourth was unlikely to survive. This created enormous competitive moats. The Washington Post utterly dominated its market in the nation's capital. It had immense pricing power, with advertisers who had no other effective way to reach a mass audience in D.C. He then looked beyond the newspaper itself. He discovered that the Washington Post Company also owned Newsweek magazine and several highly profitable network-affiliated television stations. These were valuable, growing assets that the market was completely ignoring, fixated as it was on the dying newspaper story. The market's confirmation bias was causing it to overlook crucial, positive data. Buffett then did a deep dive into the company's financials, and what he found was astonishing. He calculated that the entire company was trading on the stock market for about $80 million. He then did a private market valuation of its component parts. He estimated that the TV stations alone were worth more than the entire market capitalization of the company. In essence, an investor buying the stock at that price was getting the world-famous Washington Post newspaper, Newsweek magazine, and other assets for free. The market, in its rush to confirm its negative thesis, had created a ludicrous pricing anomaly. Armed with this objective, data-driven analysis, Buffett began buying the stock aggressively. He invested over $10 million, acquiring a large stake in the company. He then took an active role, joining the board and becoming a close friend and advisor to the CEO, Katharine Graham. He wasn't a passive investor, he was a committed business owner. His decision was a direct refutation of the market's confirmation bias. While the market was seeking out reasons to be bearish, Buffett was objectively weighing all the evidence, both positive and negative. He saw that the evidence for the company's durable competitive advantage and its profound undervaluation was overwhelming. The negative narrative was just that, a story, not a fact. The results of this investment were staggering. Over the next 3 decades, the Washington Post Company was one of the cornerstones of Berkshire Hathaway's growth. Buffett's initial $10 million investment would eventually grow to be worth over $1 billion. This monumental success was not born from a hot tip or a complex algorithm. It was the direct result of a disciplined mental process, a process that intentionally sought to overcome confirmation bias by focusing on objective business facts and actively questioning the prevailing, self-reinforcing market narrative. It was a triumph of independent, clear-eyed analysis over biased, herd-driven opinion. The psychological machinery behind confirmation bias is powerful and multifaceted. At its core, it's about reducing cognitive dissonance. It is mentally uncomfortable to hold 2 conflicting ideas in our head at the same time. It's much easier and more pleasant to live in a world where our beliefs are constantly validated. When we make an investment decision, we are also making a statement about our own intelligence and judgment. I believe this company will succeed. Information that supports this belief feels good. It affirms our intelligence. Information that contradicts it feels bad. It suggests we might be wrong, which is a threat to our ego. So our brain, seeking to protect our ego and minimize discomfort, engages in several subconscious filtering activities. First, there is biased search. We are more likely to look for information that supports our view. If you are bullish on a stock, you will subconsciously click on positive news articles and analyst reports about it. You will seek out online forums where other bulls are cheering for the stock. You will literally not even see the bearish reports, or if you do, you will spend less time on them. Second, there is biased interpretation. Even when we are presented with ambiguous information, we tend to interpret it in a way that confirms our existing beliefs. A neutral earnings report can be spun as solid performance in a tough environment by a bull, or disappointing growth by a bear. We see what we want to see. Third, there is biased recall. We have a better memory for information that supports our beliefs. We will remember all the times an analyst we agree with was right and forget all the times they were wrong. This creates a distorted historical record in our own minds that reinforces our current convictions. Buffett's method for combating this is to force an opposing viewpoint. He famously practices a technique he learned from the scientist Charles Darwin. Darwin, he noted, would pay extra attention to any fact that contradicted his theories, even writing it down immediately, because he knew his mind would be inclined to forget it. Buffett does the same in business analysis. He actively seeks out the bear case for any potential investment. He will try to find the smartest, most articulate person who disagrees with him and listen carefully to their arguments. He is not trying to win a debate. He is trying to understand the other side as well as or better than they understand it themselves. This is the intellectual equivalent of a red team exercise in the military, where a dedicated team is tasked with finding the flaws in a plan. By systematically forcing himself to argue against his own initial conclusions, he stress tests his ideas in the most rigorous way possible. He is trying to destroy his own best-loved ideas before the market does it for him. This requires a rare combination of confidence in one's own analytical ability and profound humility about one's own fallibility. It is the mindset of a true scientist applied to the art of capital allocation. How can the average investor operationalize this advanced mental model and build a system to fight confirmation bias? The blueprint is to create an investment devil's advocate protocol, a structured process for challenging your own convictions. Step 1. Appoint a devil's advocate. For every new stock you are seriously considering buying, you must find a designated devil's advocate. This could be a trusted friend who is knowledgeable about investing, a mentor, or even an online community known for its skeptical and rigorous analysis, being careful to distinguish skepticism from baseless cynicism. Your job is not to convince this person you are right. Your job is to present your investment thesis to them in the most objective way possible, and then ask them to do one thing. Please, tell me why I am wrong. What am I missing? What is the single biggest risk to this thesis? You must then listen silently and take detailed notes. Do not argue. Do not defend. Just listen. The goal is to absorb the counter-argument in its purest form. Step 2. Write the bear thesis yourself. After consulting your devil's advocate, you must perform the Buffett Munger exercise yourself. Before you are allowed to buy the stock, you must write a one-page, well-researched bear case for the investment. You must argue, as persuasively as you can, that buying this stock is a terrible idea. You need to cite specific risks, competitive threats, and valuation concerns. You should be able to articulate the reasons not to buy the stock even more clearly than the reasons to buy it. If you cannot come up with a compelling bear case, it means you haven't done enough research. Only after you have created this document and can still rationally refute its main points are you allowed to consider investing. Step 3. Create a thesis tracker. Once you've made an investment, the fight against confirmation bias is not over. It has just begun. For each stock you own, you should have a simple document or spreadsheet. At the top, write down your original investment thesis in 2 or 3 bullet points. For example, 1. Company has a dominant market share, creating a strong moat. 2. It is expanding into a new, high-growth market. 3. The stock is currently undervalued relative to its historical P/E ratio. Then, every quarter, when the company releases its earnings report, you must review this thesis. Your only job is to look for disconfirming evidence. Is its market share shrinking? Did the expansion into the new market fail? Has the P/E ratio expanded beyond a reasonable level? This tracker forces you to constantly reevaluate your original reasons for owning the stock against new, incoming data. It prevents you from falling in love with a stock and holding it long after the original thesis is broken. Step 4. Diversify your information sources. Consciously audit your media diet. If you are bullish on a particular sector, like renewable energy, make it a point to regularly read publications or follow analysts who are skeptical of that sector. If you tend to agree with a certain political or economic worldview, actively seek out intelligent voices from the opposite perspective. The goal is not to change your mind, but to ensure you are not living in an intellectual echo chamber. A healthy information diet, like a healthy food diet, requires variety. Exposing yourself to conflicting viewpoints builds mental immunity to the most extreme forms of confirmation bias. This 4-part protocol transforms you from a cheerleader for your own ideas into a skeptical scientist. It builds the habits of intellectual honesty and rigorous self-criticism that are the hallmarks of every great investor. It ensures that your portfolio is based on a clear-eyed assessment of reality, not a biased reflection of your own hopes and wishes. Finally, let us walk the path of the 99% who are guided by confirmation bias. The journey begins with an idea, a story. The investor becomes enamored with a company. Perhaps they love its products, or they are inspired by its visionary CEO. They form an initial, positive belief. This belief now acts as a powerful filter for all future information. They start their research, which consists of Googling the company's name and selectively clicking on positive articles. They find a YouTube video of an enthusiastic analyst predicting the stock will go to the moon. They join a Reddit forum where thousands of other believers are sharing due diligence that reinforces the bull case. Any negative information is immediately dismissed. A critical analyst report is written off as FUD, fear, uncertainty, and doubt, spread by short sellers. A bad earnings report is explained away with optimistic future projections. The investor is not analyzing the company. They are collecting evidence for a case they have already decided to believe. They buy the stock, and now their financial well-being is tied to their belief. This deepens the confirmation bias even further. The need to be right is now not just an intellectual desire, but a financial necessity. If the stock goes down, this creates immense cognitive dissonance. The evidence of the price decline contradicts their belief that they made a smart decision. To resolve this dissonance, they don't question their belief, they intensify it. They seek out even more confirming information, convincing themselves that the market is simply wrong and that the stock is now an even better bargain. They might post on the Reddit forum, "Thanks for the dip, hedgies, loading up the truck." This is not an investment strategy, it is a coping mechanism. They become part of a tribe, a community of fellow believers who shield each other from the uncomfortable reality that their thesis might be flawed. This can continue for a shockingly long time. As the investor holds on, their conviction growing even as their brokerage account balance shrinks. They are trapped in a prison of their own making, a prison whose walls are built of confirmation bias and whose bars are forged from their own ego. The ultimate outcome is often a massive loss, followed not by introspection and learning, but by bitterness and blame, blaming the market makers, the short sellers, or the system, anyone but the flawed mental process that led them down the path of self-deception in the first place. The direct financial connection between confirmation bias and portfolio returns is a story of unforced errors and the failure of risk management. When confirmation bias is in charge, you are incapable of properly assessing risk. Because you are filtering out negative information, you systematically underestimate the probability and impact of things going wrong. This leads to taking oversized positions in highly speculative assets, believing they are, quote, sure things. A rational, unbiased analysis might assign a 20% chance of a company going bankrupt. An analysis clouded by confirmation bias might assign it a 0% chance. This mispricing of risk is a direct path to permanent capital loss. Furthermore, confirmation bias destroys the most important feedback loop for an investor: learning from your mistakes. When an investment goes wrong, an unbiased investor performs a post-mortem. What did I miss? Was my valuation model wrong? Did I underestimate the competition? This learning is then incorporated into their process, making them a better investor in the future. The investor dominated by confirmation bias cannot do this. Since they believe their original thesis was correct and the market was simply irrational, they learn nothing. They are doomed to repeat the same mistakes with different stocks over and over again. The financial result is not just a single loss, but a pattern of losses. It's the difference between an investor whose returns get better over time as they learn and refine their process, and an investor whose returns stagnate or decline as they cycle through the same behavioral errors. Buffett's process of actively seeking disconfirming evidence has the opposite effect. It is a powerful risk management tool. By understanding the bear case as well as the bull case, he has a much clearer picture of the full range of potential outcomes. This allows him to size his positions appropriately and to demand a significant margin of safety before investing. This process directly leads to a portfolio with lower volatility and fewer catastrophic losses. The financial advantage is twofold. First, the avoidance of zeros, investments that go bankrupt, has a massive positive impact on long-term compound returns. Second, the process of constant learning and thesis testing means that the quality of his decision-making is always improving. He is not just earning returns on his capital, he is earning returns on his intellectual honesty. This is the ultimate financial payoff of conquering confirmation bias. It turns investing from a game of ego into a process of continuous improvement, creating a portfolio that is not only profitable, but also resilient and anti-fragile. You have just been handed the master key to the most dangerous room in your financial house, your own mind. You now possess a detailed blueprint of the 5 great psychological enemies: herd mentality, overconfidence, loss aversion, recency bias, and confirmation bias, that are hardwired into your brain to separate you from your money. You have seen how Warren Buffett, the greatest capital allocator of our time, has waged a lifelong systematic war against these instincts. You have been given the practical mental models, the checklists and frameworks, to begin fighting this war for yourself, to turn your greatest liability into a disciplined and rational asset. This knowledge is the foundation of all lasting wealth. It is the crucial defense that protects your capital from the emotional whims of the market, and, more importantly, from yourself. But understanding your own biases is only the defense. It is the shield. It stops you from losing the game. To truly win, you also need an offense. You need a sword. The system for actively identifying wonderfully undervalued businesses while others are panicking. The quantitative framework for calculating intrinsic value. The business principles for identifying a durable competitive moat. That is the other half of the equation. Knowing what not to do is essential, but it is not sufficient. The true mastery of the Buffett mindset lies in the seamless integration of this psychological discipline with a rigorous, business-focused analytical process. It's the connection between the mind and the math. The video that is now appearing on your screen is that other half. It is the bridge from psychological defense to financial offense. It is the missing link that connects the why of Buffett's thinking to the how of his execution. It moves beyond the realm of behavioral finance and into the world of balance sheets, cash flow statements, and the specific, quantifiable metrics he uses to determine whether a business is truly a bargain or just a trap. The journey you have taken today has fortified your mind. The next step will arm your analytical toolkit. Most people will stop here, content with the theory. They have learned to dodge the punches, but they will never learn how to strike. But for those of you who are serious about wealth building, who see this not as entertainment, but as the most critical financial education of your life, the journey cannot end here. The next step is not a choice, it is a requirement. Complete the arsenal. Forge the sword. Click on the next video and continue your ascent.